Today's market call is brought to you by MoneyLion, the first digital ecosystem for consumer finance, empowering everyone to make their best financial decisions. It's Monday, June 2nd, 11 a.m. on the East Coast, and this is a special market call. You know why, Dan Nathan? Hello, Dan.
Why would that be, Guy? Hello,
We
Guy.
have the great Carter Worth joining us in just a few minutes. Carter is the man, and the audience has been asking, well, you get what you want there, folks. So Dubs will be with us, but here's a market today that sort of cascaded lower, and over the last 20 minutes or so, you know, sort of grinding back towards unchanged. The resilience of this market continues to impress.
Guy, you can't keep a good market down.
Down.
Let's talk a little bit. So we have this ISM data. Peter Bookvar at the Book Report really summed it up pretty well. I mean, we are below that 50 level, which kind of signals contraction, but we are up. I think the number came in, Guy, at 46.7, up from like 43.6. You know, tariffs weighing on that sort of purchasing sort of data and the like here. So, you know, you can take it however you want. It's up a few points from the last couple of months, but it's still in contraction territory. And that's a good example of the sort of data that we're going to continue to see. That is just until there's a bit more clarity, you know, on the trade stuff. And, you know, and some of the headlines, Guy, and I'm just pulling up, you know, EU warns it could accelerate retaliatory tariffs over U.S. duties. Okay, so that's out there. You know, there's also, oh, this is interesting. A buyer strike rocks U.S. long bonds as double line PIMCO. These are all things that we've been talking about, like put it together in this sort of narrative. The Chinese are talking about how we broke a trade truce. You know, that's, so this is the sort of stuff that do we get, I mean, this is a question for you. Do we kind of just get bored of those sorts of headlines and the market, you know, just kind of continues to grind because it doesn't believe worst case scenarios?
Seem to, without question. And I'll tell you, of all the headlines, and you just talked about the PIMCO one, and you might as well just throw up the first slide that Stephen and Timmy and Jacob put together. It speaks about the tariffs and those types of things. But the one that really caught my eye happened, I think it was on Friday, or I think it was Friday when Jamie Dimon was speaking, I think to Morgan Brennan, and he talked about, you know, I'm paraphrasing a little bit, but he thought there would be absolute another series of events in the bond market, not but particularly good ones, by the way, and they were prepared for that. And, you know, he could see an environment where 10-year yields went to 5%. And again, you know, we've talked about that for a while. So the tariff stuff, to answer your question specifically, I think the market is sort of shrugging now at this point. I think they've seen enough of it and heard enough of it to understand that, you know, there's going to be a back and forth here. So they're not taking it all that seriously. But the bond market is the stuff that I think people should be waking up to. Yeah,
and we're going to look at that in a second. But I want to bring in the man, the myth, the legend. That'd be Carter Worth of Worth Charting. Carter, how are you? There you are.
How are you? I'm good. I'm good. Happy, first day of June, or first trading day of June, right?
First trading day of June. Now, I want to get your 2 cents on something. You know, RBC, friend of the pod, and we love Lori Calvasina. She raised her S&P 500 12-month target, but it's still, I think, 100 and change below where the market is trading right now. So I want to get your take really quickly on what you think of S&P 500 price targets, just to remind our viewer / listener here.
Sure. So my experience starts as a strategist doing mostly fundamentals at my first real job, which was Donaldson, Lufkin, and Genrad. Sold themselves in March of 2000 for over 3 times book. I don't think anyone's ever achieved that again, to Credit Suisse. Great trade for the founders of that firm, 3 buddies from Harvard Business School in the 1950s. In any event, the whole notion of a year-end target is relatively new. If you look back, people didn't have those in the 40s and 50s, the wirehouses like Kidder Peabody, if you will, or E.F. Hutton. But it became popular as a convention to decide, and that's the only word, decide what one individual thinks the market's closing price will be at 4 p.m. on December 30 or December 31st of that year. And of course, how arbitrary is that? What's the difference between a 12-month and 11-month? And the quick answer, well, Carter, it's 12 months to a year. That's why that's idiotic, right? 13 months is all. So now it is standard. You have to do it if you want to be a strategist at a sell-side brokerage firm or a boutique, and you issue a guess as to where the market will come to close, like where the roulette wheel stops, literally at 4 p.m. on the last trading day of the year. And for what it's worth, there's a reason they call it the sell side. As you know, they issue securities and they sell them to the public. The securities analysts are always bullish. Only 5% of all stocks individually are rated as sells of the 500 stocks in the S&P at any wirehouse. And then in turn, of course, the strategists are always bullish. So since data has been tracked in about 1984, strategists as a group have always called for it up here. So that's never. Why would they? Because no one wants that. No one wants the boo-hoo. Things are bad. They want the optimistic view. So not only do they always call for an up year as a group and individually for the most part, the up call is always somewhere between 7 and 12%. Guess what? That's what markets go up every year on average since the beginning of time. So there's nothing to it. And it's not reliable. And the final thing is it's not doable. So it's not their fault, right? They're caught in a convention they can't get out of. And so you get hired for the big job. You are the strategist. What's your target? And it makes people feel good who read that. But the evidence is in the pudding, or the expression is that guess what? They change it all the time. Market goes down, they all lowered it, right? When the market swooned in February, they all start lowering their targets. Now it's bounced back. Now they raise their target. So they're not predicting anything. They're just reacting to price. It's not their fault. They're just human beings who put their pants on in the morning like everybody else, and there's very little use for it.
In the course of 45 seconds, you mentioned DLJ. Great shop, by the way. E.F. Hutton, which I applied to in college and was rejected by. And then, of course, you sort of foreshadowed an Elvis Presley song.
But you made it to Goldman. So
I did. Caught in a trap. Well, the market seemingly is caught in this pennant formation in the S&P 500, and you brought some charts to illustrate exactly that. So let's walk through them here, Dubs.
Yeah. Well, what do we have? It's just what you know. Let's characterize the circumstance that we see before us. Obviously, an aggressive sell-off and an equally aggressive rebound, an epic collapse, an equally epic bounce, and the bounce leaves us back. And people like to, look at retracement levels. We're more than halfway, getting into 3/4. But what happens from here? This is truly what a pair of twos is. The temptation is to say, well, look, it's a big move up. A good consolidation should pop again. It's a misformed head and shoulders bottom. One could see that right shoulder here being a little way higher than the left shoulder of the sell-off of March. All of these things are interpretive and relative value. But your comment is the accurate one, the most accurate. Let's put the lines in. It's just something's got to give, right? So you have a lot of volatility. And so we had an epic spike in the VIX, the concomitant spike, right? Markets move first, VIX reacts down. And then we've had a vol crush, where after a big vol spike, volatility collapses, it has, and then the quiet part. And literally all eyes, it's like there's some all eyes on you. I mean, here it is, right? So now nobody knows. Anyone who tells you they know, listen, I mean, this without sounding absurd or obtuse or falsely humble. I think I'm as qualified as anyone in the world to have an answer for this. I have no clue. So there's that. I didn't even put arrows on it, right? The point is, it's a jump ball, and either is valid, and something will come along to break the stand-up. But right now, it's a pretty elegant moment of equilibrium, right? A perfect standoff. But let's look at some longer term, maybe to put this. This is obviously the 5-year, and let's put in the 150-day moving average. And generally speaking, this is where it now has to also a judgment. When you're in a bull phase, you live above a rising 150-day. When you're in a bear phase, you live below a declining 150-day. We see the 2022 bear market down 27% at that lows of October of 2022. NASDAQ was down 37%, and it's been off the races since. And then we get this, I don't know what kicked this. Was it only tariffs that made this sell-off, or was there some deep state or deep fake or something that started it or something? But anyway, we dropped 21%, and now we're sitting here, and it's totally a jump ball. I would say it's any man's guess, any woman's guess, and I think people have a lot of opinions about that. I would say this is where you react to the ball rather than anticipate. So it goes up, you got to go up. That sounds. Wait, you're saying if it goes up, you like it. If it goes down, you don't like it. A little bit like that sometimes. Just react to the ball like a good linebacker. Don't anticipate. Ball goes left, go after it. Ball goes right, go after it. Don't say, oh, well, I think they'll go left. That doesn't work. Okay, final chart. Let's look at the long term. And this is also, something that has to be on your cork board. That, 3 touch points, not a lot, but they're pretty big touch points, right? You get the 1929 peak, you got the dot-com peak. And while we're almost back to the February high, we did peak on the 19th of February at that line, and we shall see.
Well, by the way, Carter, I remember in mid-February you showing a very similar, you call that an internal chart, is that correct?
Yeah, an internal trend line, right? Because
Yeah.
the trend line is supposed to, right, yeah.
I remember on Fast Money and on Market Call, you highlighting that very chart, and you did have a 20% plunge. So I guess a retest of
Yeah.
that upside will be very interesting. And just let's rip through these before we get to gold. I know that's near and dear to Guy's heart, but let's talk about the 10-year yield, which today is up a few basis points. That means the treasury is down a little bit. It's sitting on a trend line. And I know that, you know, where you've been, and we're looking at that flat-ish 150-day. We're basically where we were a year ago. You've been consistent on that. But let's look for a second at the dollar. This is almost more interesting because this is something that we've kind of been dealing with over the last few months or so, is treasuries down, dollar down. We did have equities down. You see the Dixie now, it's down 65 basis points. We'll pull up I guess a 5-year too. Any takes on the dollar before we get to gold?
Yeah, I mean, the temptation is to say, obviously, this is weak and about to get weaker, right? That's breaking down, has broken down. It's about to now take out some of those lows that the eye sees off to the left. It seems like that's a very consensus bet, though. That's the issue, right? I think there's a lot of calls for weaker dollar. I myself, we all have PAs and things. I'm not playing this year for that break, nor for a bounce. I think it's probably going to stay here a bit and sort of get everyone all twisted up. But let's say if and as, right, the dollar really were to have a meaningful crack here again, what are the implications? A lot of people say it's very bullish. Of course, good for foreign earnings, good for a lot of things. So we shall see. I just think it's more of a pair of twos, as tempting as it is to see the perspective break to the downside.
All right, so gold, obviously. By the way, folks, if you have any questions for any of us, put them in the chat. I would say blow up Amanda's inbox. But the good news, folks, I don't know if we're allowed to say this or not,
Sure.
Dan, but Amanda had her daughter last week, baby Lola. So very exciting news on that front. Everybody's doing great. So anyway, wanted to share that with everybody. But Carter, let's take a look at gold, because the sell-offs happen. The sell-offs seemingly are gobbled up. And I think you know my view. I think I know your view. I think this trade continues. So let's walk through this a little bit.
Sure. Obviously, this has been the number one asset. Bitcoin is now back to some extent, but barring some idiosyncratic things like Palantir or you pick your, this is literally the best theme, has been and remains. So here's that same chart, just with a trend line to depict what's gone on in a period where essentially gold is almost doubled. And I would say the other way to draw the lines, we have a second iteration, is that we could flash that maybe for fun, like the vacancy sign in a motel there, right? The point is that if we leave it, we are starting to resolve. So you get that blow off. That was a blow off, and we have a pretty meaningful give back. And now, is it dollar weakness that's doing it? One could say yes, but other commodities aren't necessarily acting very well. Look at the grains, all making new lows. But the point is, I guess the bias here has to be that it's rested now after a meaningful give back and play for higher prices.
All right, fair enough. Really quickly on something similar. Let's go to the nerd gold for a second. This is our chart, not yours. Bitcoin made a brief new high.
What that was.
It's checked back a little bit. It's been in this nice uptrend. I don't know if you like our lines or not here. Thoughts on Bitcoin, because this is one where a lot of folks will point to this as just saying the outperformance when it does move, or the underperformance, you know what I mean, when relative to gold. Thoughts on Bitcoin here, because if you did have a break of this uptrend, are you thinking that we might have a move back towards the low 90,000s or something? That is a rising 150-day moving average, but just give us your 411 here.
Yeah, I mean, I think that's fair. This is what you've said. I mean, there's nothing to read into it here other than it's a big move to a former high. And in principle, you don't just easily move through it. You back and fill. It's doing that now. My bias is up and out.
All right, real quick, this is from Donald Clayton, and we have a crude oil chart, so we might as well put it up. And there are obviously mitigating factors, but he's basically asking, why hasn't the weak dollar had an impact on oil? And, my quick response would be, maybe that's the only reason oil is in these levels. It's supporting it to the extent that it is. And maybe I'll say it, Dan, but for the weak dollar, crude would be lower than it currently is trading. But just thoughts on that real quick, Carter.
Yeah, truth, right? Oil has just not responded to any currency, obviously dollar dominated. My hunch is higher. You play for a little trade here. You can see the formation since the April plunge. You see that slight double bottom, but not a lot higher, right? Can you scalp it? You know, a lot of leverage. If you have a futures account on the COMEX in New York, you can NYMEX, I guess it is. Sorry, you can get it. You know, every dollar you get five. You only put 5% down. There's a lot of leverage in this game, and so I would do it and trade out at 67 if they show you 67.
Yeah, no, listen, I'm with you. And I'm surprised by how weak it's been, but OPEC, I think this is the third time now over the last few months they've decided they're just going to basically flood the market with oil. And then one has to wonder, and I'll throw this to Dan because I think Dan's done a great job. I mean, the energy stocks have just not been performers. And you look at the XLE, which is currently trading like 82 and change. To me, it felt like it was going to break out. But real quick, if we can throw up an XLE chart going back 5 years, I mean, it's had this sort of flattening formation, Carter, I want to say since the highs of the fall of 2022. And, it's either something's going to happen here. It's either obviously going to break down or it's building a base to the next leg higher. Is there anything to glean from this?
No, just which is what you've said. So it's just a sideways for a year, and then 2 years, we're into 3 years. It was, of course, the worst performing area by far, right? In the COVID sell-off, it was the single best performing area by far on the ricochet, and now it's been the dullest. This sideways, incredible beta down and up, and now equilibrium. And I would anticipate, obviously, a resolution. It has to. You cannot. Otherwise, it has to stop trading. Many people say, well, that's what it is. It's not going to go anywhere. It's a bond. You've got 5% yields out of Chevron and Exxon. They don't cut their dividends, which they don't, essentially. And that you own this for a yield and maybe a little bit of upside potential. The real question, which can't be known, I certainly don't, is whether this is an end game, right? You'll recall there was peak oil theory. We were running out of the stuff. Those guys all make sandwiches for Subway now because they're out of a job. What a ridiculous thing. All the dinosaurs there are no more fossil fuel. Now we're awash in the stuff. But the real question is it just going to be obsolete and it's all batteries and thermal, what's the stuff in the ground, the heat, the hot water, thermal, solar. Anyway, the point is, I think that's a long way off. My hunch is to have some exposure, and Exxon will get you done, right, or that kind of thing. There's also LNG and some other sort of more modern things that are in the energy space. But energy is just 3% of the S&P, the whole sector. I don't suspect it's going much lower than that.
Yeah, and that's something, Guy, that I think you've been kind of routine in the fact that when you have one of these sorts of lows, and you can see this just in the XLE over the last year or so, you've seen a series of lower lows, but you do have some nice little rallies, but they do have almost what looks like a series of lower highs. So that's one that maybe we'll kind of take another look at as we see, some sort of resolution in this dollar move, and then demand issues and supply and all that sort of stuff, and geopolitical falls in there too. All right, we're going to hit a bunch of single stock stuff and some sectors. And before Carter's got to go, let's hit Broadcom, which reports this week. One of the things that got Carter, we spent some time on last week is like, okay, the NVIDIA quarter, people were excited about the quarter and the guide just last week as they were a year and a half ago, when the stock was really moving in some sort of commensurate way with the level of excitement. And so we saw a 3.5% move higher. And then we saw it fill in that entire gap and then close lower again on Friday. So it gave the whole week's performance up. That was saying something to me a little bit about how full up investors are in this kind of name, and specifically into this sort of narrative. But then we also had Marvell, which is a competitor to NVIDIA. They do chips, generative AI chips, slightly different. They're more specific. They're called what they say custom silicon, which a lot of NVIDIA's customers, the big hyperscalers, are also customers of Marvell and Broadcom. So talk to us a little bit about what you see here. 6.5% or so implied move, which is half of how much on average the stock has moved post earnings over the last year or so. How do you think this thing shapes up?
Yeah, I mean, to some extent, and we'll look at it possibly. It's such a, it's so similar to obviously Palantir, right? Before it
Mhm.
had its numbers, the great run up over a multi-year period, it collapsed. I mean, what is this? This is 250 to one, what, 140, 135? That's almost 50%. And then an equally epic rally right back to the scene of the crime, right? The peak from which it sold off. Not for the faint of heart, but it always is and ever is knowing who you are in the market, what your timeframes are. How many people to think bought, let's say, for the breakout in December and paid 200? Good technique, 205. It went to 250, stayed, and then rode it down to 150 and punted and have a horrible experience in the stock. They're like, my God, I lost so much money. And other people who bought at the low and are still long had a wonderful experience. There are people who are holding it forever. They put it in their children's, grandchildren's deepest, farthest away account. They're never going to touch it. And they believe this is, and possibly is, it's the Apple, it's the General Motors of its day, the U.S. Steel of U.S. Steel lore. And so all those things are valid. But what we know is, as a circumstance, not for the faint of heart, it's a great trading tool and a great, it turns out, a buy and hold tool or thing, at least for now. Does it break out? Let's put some lines on it. I think this is jump ball. The one thing to consider is how Palantir acted. It basically backed and filled for a little bit, but I literally, that's 50-50 to my eye. And I think here too, one could say yes, but based on my study of stochastics and RSI, or based on the recent relative performance to the SOX index, that would suggest it's going to break. Okay, if that makes you feel good, but I just think that it's a jump ball. That's to my eye. But
Yeah.
look at for fun.
Well, let's look
We
at
might have
Palantir
yeah,
because
please go
we
ahead.
have a
Yeah,
lot
go
of
ahead.
we have a lot of questions about Palantir, and real quick about Broadcom. I mean, I think you're spot on. And if you just put real quick that chart back up, I mean, this is one of those things where you don't really have to do anything here. You let price be your guide, because if we fail on earnings at this level, I think you pretty much have a textbook double top, and there's a really good chance you do at least a 50% retracement of that move, which gets you down to 200. But if we close above it, people will say we're getting ready to have the next trading range higher. So I think Carter's right to call it a jump ball. I agree. Let price be your guide on this one. But as I said, a lot of Palantir questions. So let's look at your Palantir work.
And now let's sort of remember, obviously, it's easy from the Avago chart. And then what did Palantir do? Palantir goes right to the former high, and it backed away, and backed away substantially, dropping about 10 to 12%. Then pushed above that high, then faltered again, and now slightly above. Meaning, guess what? That didn't reward shorts or longs, right? Unless you, the moment at which it first returned to the former high, it dropped and gapped. If you were short, you would have obviously made money. So is this a roadmap, or is this what's likely for Avago? I would just say the trick here is to stay away. It's sort of, or it might be, and this is the most dangerous of all. It turned out, guess what? The one thing that would have worked with Palantir is selling volatility, because people expect the thing to really break down and never did. Now that's dangerous stuff. You could get really trapped if you have a big move in Avago. So in that case, I would not do it. It's just too darn risky.
Well, you can get really trapped. Hold on one second here. Hold on, people.
What happened?
Hold on. I lost my
IFB.
Yeah, hold on. Give me a sec here.
I wonder what do we know what the implied move is? How much? 6% for PLTR?
I'm going to find out in a second. As Dan, I think Dan lost his IFB. I'm not sure.
It is.
But while he's searching, let's walk through Palantir here, because this, we've talked about this a number of times, and I know you're very equipped to talk about fundamentals. It's not something you look at, but the fundamentals don't make sense. But with that said, it's hard to sort of argue the price action here, Carter.
Yeah. So I was just looking. The implied move for Avago is only what you guys had said, 5-6%. So it's very muted. But if we go to Palantir, now that it gets to the former high, right? It drops substantially. It reasserts itself below, and now it's a long, right? In the sense that it's worked through with enough time. That's the key, and enough ability to trap people, shorts or longs. Now it would be comfortably above the former high, and I would think the right technique here is to have a long and to ride it for, and we'll see maybe the next quarter, but for now long.
One really quick point here, and I'm back, baby. Our team, our crack staff here. This stock sold off 12% after its earnings. Maybe Stephen could pull up a chart here really quickly, a 1 year or something like that. And it's getting to a point based on, this is a $300 billion market cap company. Okay. It trades at 79 times sales. If I told you it traded at 79 times earnings, you'd say, you know what, I might think twice about this. 79 times sales. And then next year it's trading at, it's 61 times sales. They're growing sales this year. Basically, earnings are growing 42%. Next year expected to grow 26%. And they're expected to do $4 billion in sales, $308 billion market cap. Next year expected to have 29% revenue growth. This makes no sense unless you can tell me for a whole myriad of reasons why that $4 billion in sales is going to start accelerating the way NVIDIA did, 2 years ago or something like that. Now, on a 1 year basis, you can say that's a nice little consolidation. The reason why it's rallied on Friday, because they got a DoD contract. Okay. And so there's obviously a lot of short interest here, and people feel like this is one of the very few pure plays on kind of defense tech. Anduril in the private markets probably has a $40 billion value, but it's growing much faster. So that is what it is. Carter Braxton Worth, we appreciate you being here on a Monday. We'll see you back on next Monday.
Thanks, guys. Okay.
Thank you.
Trade well.
You know where to find his work. worthcharting.com. He does a evening video. He puts out charts on a daily basis. We're really lucky to have him here on a Monday, guy. The Palantir thing, it still blows my mind. And I guess it's going to continue to blow our minds until, you know what I mean? We just, there's some sort of resolution. But if this thing is on its way, even if they guide it up, and they said, we're going to do $5 billion this year and $6.5 billion next, right? So, or $7 billion. It still wouldn't make sense.
Mm-hmm. The valuation on you just hit the nail on the head. By the way, the first time up, we were spot on. And as Carter said, it really looked like it was going to cascade lower, and then it completely about face. So the only, in my opinion, the only compelling reason to continue with this is just a momentum trade. And you're just sort of trying to catch something that you've seen before in other names. But at a certain point, I think we all agree that valuation is going to, it has to catch up to this unless there's some revenue growth strategy that has not been put forth. It's a hard one to get your arms around. Real quick, we have a couple questions. Regeneron is an interesting one, and I think that comes from Ben M141. So Regeneron, I think, made an all-time high, I think, the summer of last year. Since that point, trading, I think, north, Dan, of $1,400 or $1,200 or so, the stock is cascaded lower. When I say cascaded, we're now at levels that we last saw in 2021. So the question is, do you buy it for a bounce? Well, you know what? You're getting damn close, because the March of 2021 lows, I think, were about 450, 460. So I guess if you want to wait for that, that's one way. You say, you know what? If you do a longer term chart, Stephen, you'll see. You can say, maybe I'll just wait for it to get there and take a shot. But man, oh man, this is the deep end of the pool shit, Dan.
Yeah. And obviously you guys know I have no take on this stuff whatsoever. Guy, so we get in the morning. We've probably already read, 30 articles and, this and that. We're spanning all over the place and to see what's moving one way or another and trying to figure out why. Mm-hmm. Autos this morning, I don't think it's such a hard one to figure out. I think Friday night it was that Trump said that steel tariffs are going to go from 25 to 50%. And this kind of speaks to some of the uncertainty that we're going to have in and around this kind of trade rhetoric, right? And so I look at this, GM, you and I had been very surprised at that initial hit, that it was as muted as it was, right? And if you think that autos and steel are a big part of these kind of trade negotiations, that's important. Now, you see that uptrend that's been in place from the April lows. We kind of just, kind of broke below it. It's just one day, but I think this is interesting because it got rejected as flattening 150-day moving average. Ford is also down 4.5% today. Thoughts on autos, because it's not something that's been on the tip of our tongues over the last month or so as we've kind of gone back and forth with trade tariffs and the like. But how do you trade these here?
Well, I think first of all, Ford is a disaster. I think everybody agrees. So let's just back that out for a second and let's just sort of go to GM. if you look, I mean, 42-ish has been sort of this. I'm ishing, by the way. 42 and a half, 43 has been sort of this line in the sand for a while. You go back to September of last year, then you go back to late September of last year, then this recent low that we saw in April. That's the level you trade against. And this is my take. As much as he's going to talk, and you know, we led the show with this, a big game about tariffs. There'll be points where he talks about potential carve-outs for our big three automakers, and you know, Stellantis, Ford, and GM. GM is the one you got to focus on, and you have to be sort of anticipatory there. And as it potentially gets back down to that 44 level, as scary as it's going to look, I think you got to get long for a trade again. That's just my 2 cents.
Yeah. You know, I agree. I mean, like at some point, if we didn't see like extreme price movement to the downside and we didn't see it back up on the upside, especially relative to the S&P 500, you'd say to yourself that investors seem to kind of be looking past some of this stuff. And specifically to your point in GM, they seem to have been better operators than Ford has, like, and we could take that one to the bank. Here's another one that caught our eye today, which would be the home builders. And, you know, we already talked about 10-year yields, you know, only up 3 basis points or something like that. We've definitely seen some volatility in and around yield movements here, but not a big one today. But look at that thing since it broke that uptrend. And we've showed you a lot of charts so far that have had some nice little uptrends, but this is a great example of one that is so far above its highs when you have an S&P that's just a few percent from its all-time high. So it tells you a little something about what investors perceive is going on in that industry, independent, let's say, of yields. There's supply-demand dynamics here. So thoughts on this one, because this is a break that has been in the works for now, I don't know, a week and a half or so.
As much as, and one we've actually discussed for a while, and here you go for the t-shirt lovers. I mean, this is a static chart, but if you want to put up a longer term XHB chart just to sort of illustrate what's going on, as much as people say it's about interest rates, and that obviously is a big part of what's going on, I think more of it has to do with what's going on the labor front. And, you know, if you see, in my opinion, you know, you see deterioration in the labor market, almost by definition, you're going to start to see a deterioration in the home builders. Now, I don't think the XHB is the best constructed ETFs we've ever seen, but if you look at some of the individual home builders, Toll Brothers, DHI, Pulte Homes, they're all going to look pretty similar in terms of this peak to trough decline. Now, certain home builders obviously lend themselves to the higher end, others not so much, but they've all starting to roll over. And, you know, I think the broader market should be paying more attention to what's going on with these stocks, Dan.
All right. Here's one from Scott Rogers. This is right in your wheelhouse, guy. And I've been sitting next to you on Fast Money for 14 years. And if we make it to January, you will have been on for 19 years. Is that right?
Big if. There's always an if, man.
Yeah, no, there's a big if, but Netflix. This is one where I honestly don't think, other than what you just said about Broadcom, or you'll say every once in a while into an earnings print where expectations are getting high, you'll say sometimes you got to move your feet. If you had this, you know, from, you know, what is that price? It was 700-ish or something like that. And now it's at, you can do the math here, it's at 1,200, that sort of thing. You know, you might want to move your feet. If you are a trader, if you kind of bought down there and you're looking to see what's going on, but you've always been one of those, that was, I guess it was 8.25 guy at the April lows. And here we are at 1,200 at all-time highs. Look how far it is above its 150-day moving average. So Scott Rogers, when will Netflix stop going up? I can't buy into the FOMO. I want to say one thing before I get your take. Barry Diller, who is a legendary media guy, we can all agree on that, the last 50 years or so. He was on Bill Maher's show the other night on HBO, and Bill was asking him about, you know, just in general, the streaming and this how everything's changing in the media landscape. And he definitively, just like our friend Tom Rogers has said, no relation to Scott Rogers, just as you've been in this camp, he's like, Netflix is one and nobody's going to catch up. You know what I mean? That sort of thing. So how do you feel about FOMO here? Because there's definitely a bit of that going on.
Nobody's going to catch up without question. A lot of companies have tried unsuccessfully. And listen, Netflix has had a couple pitfalls along the way as well. But what's amazing is the market gives them a huge, basically a huge latitude in terms of some of the mistakes they've made. And they've given it into them in terms of valuation as well, because you're clearly not buying the stock on valuation. But to answer your question, Scott, this is Dan, and you can look it up for me. It typically trades about 5 million shares a day. I don't know what we've traded today. We made an all-time high today. But for example, if this stock were to reverse and close lower, and maybe close lower than the lows we saw on Friday, then maybe you can start to look at a formation where we have a bit of an engulfing pattern, and maybe there's a chance to buy this stock cheaper. But short of that, or that type of formation, you just got to sort of ride the wave right now. And it's not us talking here on this Monday. I mean, I think we've been pretty consistent on this name for quite some time.
Yeah, I mean, this is one where I think fundamentally I totally buy into it. I think they have so much optionality as they kind of move away from, or if they choose to move away from, some of the original content they do. Obviously, the libraries that they have, it seems like they have so much pricing power, Guy. It seems like recession proof. They've never lowered prices and they continue to raise them. It's pure margin. If you think about it, they're moving into some live sports. They have not been that committal about how they're going to bid for sports rights, but what they did on some of the, they've dipped their toe in on some NFL here and there, and the UFC stuff and the boxing. It just seems like they have lots of levers to pull. I'm not. This is a great example though of a stock that if you love the story and you kind of get, you just don't want to play into the FOMO at different periods, and just look over the last year or so, you can see they have this runaway breakouts. You have these consolidations, but when you get those pullbacks, but the question now is 8.25 to 1200. What's the pullback? Is it that's viable? Is it the 150-day? Maybe, that sort of thing. So again, all right, we covered a lot of ground here. Anything else, Guy, before we get out of here?
No, a lot of questions. And again, our congratulations, obviously, to Amanda and her family. I know the listeners and viewers feel the same way. My sense is they'll be blowing up certain inboxes and what have you over the next couple of days, as they should. But the baby is absolutely beautiful. Cece is a great big sister. Amanda and her husband are thrilled. So we're obviously thrilled as well. We will be back tomorrow. Another busy week at Risk Reversal Media. We obviously have the live show on Thursday on Fast Money. And as we're sitting here right now at 11:37, there are a handful of people maybe watching this right now that will be in attendance. So thank you for that. And we look forward to seeing you.
Yeah, make sure you say hi at the event, because it's a really fun thing. We'll have a nice cocktail hour, and they're sold out, but they released a few tickets last time. I want to say the week of, guys. So if you guys are really interested, we have a code that I think will still work. If it doesn't work for any reason, just hit us. But go to Fast Money Live or search for it, and our code there. Look at that. Look at that. I think they're going to release like another 5 tickets, Guy, because they have capacity issues. I think that was a big thing at the NASDAQ. So check that out. Also, tomorrow morning, we have a guy named Mike Dempsey is going to drop in the Risk Reversal podcast. He's a VC at Compound. He's a genius guy. I mean this. He's a young guy, a genius guy, and he's been investing in generative AI companies for a long time before it became the flavor of the month. A couple of years ago, he's invested in autonomous vehicle, companies. So we're going to hit a bunch of use cases. It's going to be a great conversation, very digestible. So check that out tomorrow in the Risk Reversal podcast feed.
And real quick, we had a really fun conversation, an insightful one with Sarah Levy. That podcast dropped today in Risk Reversal. If you want to listen to that, Sarah Levy is the CEO of Betterment for the last, I want to say 5 years or so now. Prior to that, she was at, I believe, Viacom, and she was instrumental in getting Yellowstone, the series, to Paramount Plus, and we actually discussed that a little bit as well. But she's, I think, really interesting. I think she really has a good, firm understanding of what Betterment is and what they're trying to accomplish, and I think it's a conversation absolutely worth listening to.
Guy, in the biz, they say she greenlit. She greenlit Yellowstone.
I don't know what that means, but yeah.
Really? But you got into you enjoyed that conversation. I think you could have had a whole podcast.
I could do an hour-long conversation about Yellowstone.
You got pretty fired up. No, but they've been great partners of ours, Betterment, and it's really interesting to hear the way she sees that business growing. They have 1 million customers, $56 billion under management. I remember first hearing about this company, I want to say about 8 or 9 years ago, and at the time they might have had 2 or 3 billion under management. They probably had a couple 100,000 customers. So, all right. Thank you, guys. We appreciate you being here. Appreciate all the questions. Appreciate Carter Braxton Worth. We'll see y'all tomorrow.